Out of 100 people, 4 will get the message.
Turning on the TV news, you've probably been bombarded with the words NASDAQ, S&P 500, DAX, Nikkei, FTSE 100. They're all indices, but how do you trade them? First up, what are indices? Think of each one like a basket in a supermarket. Take the Dow Jones Industrial Average, or Dow 30. It's made up of 30 leading companies listed on the US stock exchange. From industrial heavyweight 3M, tech giant Microsoft, to the iconic Coca-Cola. So why do they exist? Well, indices can be used as indicators of the wider performance of industry or even a country's economy. Want to know what's up with the tech sector? The NASDAQ 100 might be a port of call. These indices use a numerical value to offer a snapshot of performance from whatever market they're covering. But you can't actually trade an index, at least not directly. But there are several ways of trading on the data an index provides, each targeting a different style of trading. The index mutual fund is one of the most common. Then there's index exchange traded funds, or ETFs. And finally, the world of derivatives, involving options, futures, and contracts for difference. Let's start with the index mutual fund. Created by and purchased from financial institutions, banks, and brokers. These funds basically copy an index or a portion of it. For any one index like the FTSE 100, the NASDAQ, the S&P 500, there can be dozens, if not hundreds of index funds, all tracking the same data but offering different returns and rules. Now, within this pool of funds, there are two subtypes. Actively managed index funds, and the people who run them aim to outperform the index they are based on. The trader pays for the privilege of this supervision, usually in additional fees for management, performance, and even transactions. Passive index funds, on the other hand, don't try to outperform the index. They just match it. So they don't have any active management, and the traders pay much lower fees. Whether you're passive or active, index funds are designed for investors looking for the diversity of a basket of assets, and who are willing to ride the ups and downs of a market over the long term, potentially sacrificing the volatility for stability. Now, next up is another type of fund, exchange-traded funds. At first glance, index ETFs might seem a lot like active index funds, since they both track a diversified basket of assets and are managed. Unlike index funds, they can be traded on exchanges just like stocks, as well as through brokers. And they're priced in real time, so they adjust to the market's minute-by-minute movement, meaning their value can rise or fall rapidly. Okay, so that's the funds. Now, if a trader wants to step away from directly involving themselves in the underlying asset, there are derivatives. Derivatives are contracts, usually between a trader and a broker, which just tracks the price movement of the underlying asset, in this case, an index. More geared towards shorter-term traders, their price movements, like ETFs, are in real time, and so are more volatile and riskier. Three of the most common derivatives are CFDs, options, and futures. CFDs are contracts, only available in certain countries, that allow speculation on price movements of indices. The profit or loss from a trade is determined by the difference, up or down, in an index's price from the start of the contract to its end. Now, before we go any further, just a bit about us. Here at Capital.com, we make explainer videos about investing and economics, giving you the insights you need to understand what's going on in the markets and to make informed trading decisions. We're also a trading platform ourselves, where you can trade on indices using CFDs right on our website or using our app. After this, you might want to check out our other videos like this one on how to trade Forex. Right, back to derivatives. Next up is options. They give the contract holder the right, but not the obligation, to buy or sell the value of an index at a specified amount by a certain date. As the transaction is optional, traders pay a premium on them. And last, but by no means least, futures. They may sound similar to options, but futures contracts on indices are all about the commitment to transact the value of an index at a future date at an agreed upon price. Okay, that covers the financial instruments, but when it comes to trading them, there's another important element to consider: margins and leverage. Let's start with margins. Only available on index funds, some brokerage accounts allow a trader to buy in with money borrowed from the broker, known as trading on margin. As index funds are long-term investments, the broker usually charges interest to make it worth their while. If a trader opts for the real-time market or ETFs or derivatives, then they can trade using leverage. Similar to margins, but the difference being rather than charging interest, the broker makes money on the spread of the index, and management fees. In both cases, trading on margin or using leverage amplifies the trader's position, potentially magnifying both gains as well as losses. I hope our video has demystified the world of indexes. If you liked it, have a look at our YouTube channel where we've got many more explainers. And remember to like, comment and subscribe. And I'll catch you next time.
You want to know how to be a successful investor? The answer is stay with what you know. Don't listen to me. Don't listen to TV people, internet people. Just stay with what you know. If I told you you can only have 20 investments in your life, you would be very careful. You wouldn't be jumping in and out, listening to hot tips every day, every month. You would stay with what you know and you would become a successful investor. Everybody watching this knows a lot about something, whether it's fashion or cars or sports or something. When you see something that you know is going to be successful and exciting, don't just say, oh, that's going to be great. Don't tell all you. Then you go and you do your research and you figure out how to and if you should invest and how to invest, and then you invest. You will know it long before I will, or long before other people in the investment community. You will also know when to sell, because you will know when something's going to change again. Nobody likes to hear it. Everybody wants a hot tip. Everybody wants to be rich this month. In those days, we did nothing but focus and concentrate and dig deep and dig deep and dig deep.
Hi there, Greg.